Ladies and gentlemen, good day and welcome to Uniparts India Limited Q2 and H1 FY26 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Monali Jain from Go India Advisors. Thank you, and over to you, ma'am.
Thank you, Amshad. Good evening, everyone, and welcome to Q2 and H1 FY26 earnings call of Uniparts India Limited. We have on the call Mr. Gurdeep Soni, Chairman and Managing Director, Ms. Tanushi Bagrodia, Director and Group Chief Operating Officer, Mr. Rohit Maheshwari, Group Chief Financial Officer, and Mr. Himanshu Sharma, Deputy General Manager. We must remind you that the discussion of today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that company faces. I will now request Mr. Soni to take us through the financials and the business updates, subsequent to which we can open the floor for questions and answers. Thank you, and over to you, sir.
Thanks a lot, Monali. Good evening, everyone. I welcome you all to the Q2 FY26 earnings call of Uniparts India Limited. The global off-highway market, after a prolonged period of softness, is showing early signs of stabilization, particularly within the construction equipment segment. Uniparts Q2 performance remained consistent with Q1, delivering a 14% year-on-year growth. This is in line with the guidance we shared in earlier calls and reinforces our confidence in achieving double-digit growth for the FY26. Our operations remained stable through the quarter, despite the untimely and severe floods in North India, which is a testament to the resilience and agility of our team and the robustness of our operational processes. Our dual-shore manufacturing model continues to offer customers flexibility and risk diversification, thus strengthening our position as a strategic supplier. This model has also enabled us to effectively mitigate tariff-related challenges for our customers in USA. As we navigate an evolving global environment, our teams continue to grow stronger, more agile, and better equipped to manage volatility and deliver consistent performance. Let me give you a little industry overview of our business. The off-highway equipment market appears to be stabilizing, with encouraging signs seen specifically in the construction equipment segment. The agricultural industry is seeing differentiated performances across segments and across geographies. Let's start with large agriculture. The North America large agriculture market continues to be soft, with a forecast continuing to be a high double-digit degrowth. This is largely driven by continued subdued commodity prices, high input costs, and still high second-hand inventory. The European large agriculture market is faring much better, driven by lowering input prices and with some markets showing an improving momentum of agricultural exports. Uniparts' growth in this segment is supported by new business awards from our European customers. Talking about the small agriculture, while still soft, the North American small ag market is better than the large ag market, expecting to degrow between 5% to 10%, with the compact equipment segment showing momentum. However, in Europe, the small ag demand is showing better outlook than the North American markets in India. And in India, of course, the good monsoon, the high traction utilization, and the recent GST rate cuts are expected to generate anything between 4% to 7% growth in tractor volumes in this current financial year. With strong domestic footprint and growing export market, Uniparts is well positioned to capture mid-teen growth in this segment. Coming to the construction side, the increasing spend on building AI infrastructure is aiding construction industry growth in North America markets, leading to improved end customer demand. In Europe as well, the government spends are encouraging the demand of construction equipment, especially with the focus on developing green power. Uniparts continues to grow ahead of the market, supported by strengthening customer relationships and new business wins in both Europe and North America. And finally, about the aftermarket, this segment continues to be an important business driver for Uniparts, and we expect to grow in single digits in this segment year on year. Let me talk about some operational update and strategic outlook. Uniparts remains focused on deepening customer partnership and expanding our footprint in large agriculture and construction equipment segments. In fact, our new business award pipeline continues to be robust at around 200 crores. In addition, the Mexico warehouse has become operationally ready in October 2025, in line with our planned schedule, ensuring we continue to meet customer delivery timelines seamlessly. A brief about our financial performance. In quarter two, our EBITDA margin expanded to 22.6%. Cash flows remain robust, and the company continues to be net debt-free, with a net cash balance of 226 crores as on September 30th, 2025. In fact, the board had approved and paid an interim dividend of 37.7 crores for the quarter FY26. In fact, in addition, there was a special interim dividend of 22.50 rupees per share, amounting to 101.55 crores approved and paid in October 2025 as well. With that, I'll hand over to Rohit Maheshwari to present the detailed financial performance for the quarter. Rohit, over to you, please.
Thank you, sir. Good evening, everybody. Here are the financial and business highlights for the quarter ending September 30th, 2025. Quarter two total revenue was 283 crores, reflecting 1.3% quarter-on-quarter increase and 14.6% year-on-year growth. Quarter two EBITDA stood at 63.9 crores, up 11% from Q1 FY26 and 53% year-on-year. Operating cash flow generation for Q2 was 34 crores. The net working capital, comprising of big three elements of inventory, account receivable, and account payables, as number of days of TTM revenue from operations stood at 155 days as on 30th September 2025. Uniparts remains a net debt-free company with a group net cash position approximately of INR 226 crores at the end of 30th September 2025. Capex outflow during the quarter was approximately rupees 6 crores. New business awards over the past 12 months total approximately 200 crores in the analyzed potential value. Key monitorables include global economic slowdown, geopolitical uncertainties, evolving trade tariff, persistent inflation, and elevated interest rates. With this summary, I would like to hand over the conference back to the moderator for question and answer session. Thanks very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj from Simple. Please go ahead.
Yeah, thank you for the opportunity and congratulations on good set of numbers. So just a couple of questions. First is, if you look at the current quarter, our gross margins has been one of the highest ever, in our own history. So just trying to understand what drove such high gross margin for us. Was there any element of FX gain or, or any other element? And similarly, there's slight increase in OPEX costs as well. So just, if you can just give some perspective. That is the first question.
Hi, Viraj. Tanushree Bagrodia here.
Hi,
Good afternoon,
Tanushree.
everyone. Viraj, you asked a question on our gross margins and on our overall other expenses, right? So if you look at our material cost as a percentage of revenue, typically it is in the range of about 35 to 37%. And this has eased to about 32.5% in the first half. And in the quarter two, it's at about 30.5%. And this is largely due to the rupee's depreciation, which has improved inventory valuations across our US and European businesses. And
can you specify the quantum?
Yeah. So if you look at this, a large part of it is coming because the rupee depreciated about 3 rupees against the dollar and the euro both. So about 85 to 90% of the impact that you are seeing on material cost is because of the FX movement. And to a smaller extent, there is an impact of product mix and of tariffs as well.
Can you quantify both the parts, the impact in Q2, both at the gross level and also at the other expenses?
So on the gross margin, like I said, 85 to 90% of the impact is due to FX, and the balance is a mix of product mix and of tariffs. Now, coming to your question on the operating expenses, you would see some higher costs on employee costs, which is largely driven by actuarial valuations. And the next impact that you see is on other expenses, and those other expenses are largely up because of one-time expenses.
Okay, so if we were to kind of weed out the impact both at the gross level, which is positive, and the expenses and the other expenses, employee costs, then what should be a normalized operating profit should be for us in this quarter?
So Viraj, what we've always maintained is that with the market picking up, we are back to looking at the 18% EBITDA levels. And I think after normalizing for all the gross margin and the fixed cost impact, right, we are well in the range of 18% EBITDA margin.
Okay. Second question is, if you can just give some color in terms of our performance when it comes to large ag, small ag, and construction. And a related question is, if I look at the aftermarket business, if I look at last 2 quarters, we've seen subdued sales, maybe minor decline or kind of flattish kind of a sales. So what is happening there, because I think we were looking at ramping up the supplies to our large US retailers. So any color you can give on both the parts?
Okay. So let's start with where the markets are and where we are performing in terms of the market, right? So as our MD also mentioned in his opening address, the North American large ag market continues to see soft crop prices and higher fertilizer costs. And hence the large ag segment continues to be weak. However, the recent agreement that has been achieved between US and China on the soybean purchasing by China is going to be beneficial for US farmers. The Fed rate cut has come in October, and that should be beneficial for farmers as well. Secondly, we also see while the inventory levels are high, the inventory levels in large ag also are consistently reducing. These factors indicate that the large ag market still has some pain to go through, but is potentially bottoming out. And in this backdrop, our business in North American large ag market is flat, right? In the European large ag market, the input prices have stabilized and the Southern European farm output exports are looking up. The European agricultural market seems to be coming out of the trough this year. And this region is definitely faring better than the North American market. And Europe is currently driving Uniparts growth in the large ag segment, which is fueled by the new business wins that we spoke about in our earlier investor calls. And with the improving market sentiment, we are getting an additional uplift. Then when we talk about the small ag segment, I think the Asian market, which is largely a small ag market, has been performing relatively well. And we've actually won new business, and this is also driving growth in the Asian market. Now in India, monsoon, steady farmer demand, and the GST rate cut is driving tractor sales. And I think here also we are outperforming the market. A, because we have a dominant position. B, we've also seen that the GST rate cut has provided some impetus to this market. In the European small ag market, this segment has clearly bottomed out, and we are leveraging this upturn and securing new business, and again outperforming the market. So I think that overall gives you a color on how we are performing in the small ag segment. Needless to say that our very strong leadership and dominant position in this market is helping us outperform every geography in this particular segment. Then when we come to construction segment, this segment is showing green shoots across the US and Europe. In US, as the chairman mentioned, it's driven by the spend on AI infrastructure. In Europe, it's by green energy focus. But clearly, this is a segment which is driving growth for us, both on new business wins that we are executing currently, and the businesses that we had won in the recent past having done exceedingly well for our customers. So this segment also remains extremely strong for us. On the aftermarket side, we definitely haven't degrown. We have seen growth. It's just that the growth is less compared to what we saw in the previous year. Again, let's look at aftermarket in two buckets, Europe versus the US. I think in Europe, our aftermarket customers are sitting on higher inventory, and hence their buying from us has been lower, and hence the growth is a little subdued. In the US, while the OEMs have seen zero impact of tariffs, the aftermarket has seen some impact of tariffs, and hence there has been some slowdown in growth. Having said that, on 31st of October, there was a new notification from the US government which came out that certain HSN codes which come under tractor parts will now be subject to 25% duty.
Only, no Russian duty.
Yeah. So these were initially falling under the 50% duty because 25% duty and 25% Russian oil tariffs. Now this is flat 25% duty, and it's exempt from Russian oil tariffs. With this new ruling coming in, we are seeing some green shoots in the US aftermarket already. So I think that's some color on the aftermarket for you.
Okay, last question and come back in queue. Can you give mix in terms of channel, say warehousing, direct export, local production, both for Q2 and H1?
So I think it remains pretty much the same, where our sales from warehouses remain the highest at about 50%, and our direct exports is about 25%, and the balance 25% is local, made to local sales.
Okay, I'll come back in queue. Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Prolin Nandu from Edelweiss Public Alternatives. Please go ahead.
Hi team. Thank you for giving me the opportunity. Few questions from my end. Firstly, you sounded like slightly more positive on construction equipment side than the agri side, right? So just to understand, in let's say in your order book or maybe FY26 revenue, how should the mix look like between construction equipment, large ag, small ag, and aftermarket?
So I think if you look at, Julian, thank you for that question. I think before I go on to what our order books are looking like, I think we have been maintaining this that the construction industry has seen a sooner revival than the ag industry. I think what's a clear indication within the ag is that even the North American small ag market, probably the bottom is behind us. And in the case of the large ag industry, now we are seeing that, the potential bottoming out should reach soon. The European industry ag industry is definitely seeing green shoots. So I think that trajectory is now becoming more and more clear as we've gone by one more quarter. What we are seeing is that our construction business is roughly about 40 to 45% of the total business that we have, right? While the large ag is roughly about, I'd say, anywhere between 17 to 20%, and the small ag business obviously is larger, right, with about 25%.
Okay. So just to summarize, right, if I were to probably, think about this traffic lighting kind of a system, so what you're saying is that construction element is purely green, small equipment is more like a amber, and there's still some red on the large ag side, right? Is that a fair summary?
Again, I'm going to temper it by saying that large ag in the North American region is red.
Sure.
I'd say small ag plus the European large ag is an amber, and construction is green. And India and Asia ag, which is the small ag, is all green as well.
Okay, that's very helpful. My second question was on the inventory adjustment, right, which explains 85% of the the gross margin expansion. Now this is only on inventory, right? How do we pass on the depreciation of currency to our end customers in terms of pricing? And I'll tell you where I'm coming from, right? Some of the channel checks that we have done, right? What we understand is that in terms of pricing, when the raw material inflation goes up, we are quite quick to pass on the same hikes to our customer. Maybe while declining, we are slightly late, right, in a way. So we probably maybe lose out on wallet share or lose out on some of the customers. So has there been any such instance in the past where we have lost out on a customer or lost out on wallet share because our pricing was slightly on a higher side? And how do we, factor in all these factors, right? Currency movements as well as the raw material movements, and how do we pass it on to our customers?
So, Prolin, if you look at our customer contracts are fairly clear. Our customer contracts talk about raw material inflation and about FX. There are bands at which there is a clear decision point saying if the raw material goes up or down, how is the passing on going to happen? On the FX side, I think one thing that we need to understand is that FX is not looked at in isolation, because FX also comes hand in hand with inflation, right? Because if the rupee depreciates, there's also an inflation in India which is there. So we always go to the customer with a transparent contract which looks at what we need to do for raw material and then in combination with FX and inflation. So for us, these pass-throughs are transparent, are done timely, and contract to contract, it depends, what the frequency at which the reviews will happen and when we do the pass-on. As a supplier to our customers, we are actually a strategic partner. And what that means is that we have a seat at the table when any of these discussions come up to engage in open, detailed conversations and then find a solution which is balanced and contractually agreed to by both parties. Now, that's also the reason that we've been able to pass on all tariff impacts with P&L neutrality and not losing any business. So I would like to say that any pricing discussion that happens timely, contractually, and given the strategic nature of our relationship. We do this in such a way that we are not losing wallet share or business with the customers. In fact, even post tariff, we've not seen a reduction in RFQs also.
No, that's very encouraging to hear. I'll just push one last question, right? And that's on, inorganic growth or acquisition. What is our plan there, given that the payout has been very high on dividend side? Is that plan temporarily off the table, or are we still evaluating to do something on the inorganic side? That's it, Tanushree. Thank you so much for answering my questions.
So, following global inorganic growth remains a core part of our strategy, and at all points in time we've maintained that and we'll continue to maintain that. We continue to focus on these areas around our key platforms of fabrication, hydraulics and PTOs. Right? These are the areas in which we see strong potential for value creation and strategic alignment. I think the decision to declare the special interim dividend was because while we are evaluating potential inorganic growth opportunities, the board believes that distributing surplus cash to shareholders was a prudent use of the capital. At the same time, it reflects our commitment to disciplined capital allocation. As the profitability of the company is improving and is indicated by our half-yearly results, right? You can see our EBITDA. And you can also see that we continue to generate strong cash flows. We are very confident that this interim dividend that we've paid out will slowly come back to our coffers. And hence it was most prudent to deliver value to shareholders at this point in time. Also because we are a net cash company, we remain debt-free, and any opportunity that also materializes, I don't think we are constrained in making an acquisition at this point in time.
Great. Thank you so much.
Thank you. Ladies and gentlemen, in order to ask a question, you may press star and 1. The next question is from the line of Rishabh Shah from Bugle Rock PMS. Please go ahead.
Hi, so thanks for the opportunity. My question is, in one of the calls you had mentioned that South America is an undiscovered market for you, and an opportunity is coming up. So are we taking any efforts to increase our business in that particular region?
Sorry, Rishabh, your voice is not clear at all. You can't understand your question.
Yeah, hi. Am I audible now?
Yes.
Yeah, so in one of the calls you had mentioned that South America is an undiscovered region for you and an upcoming opportunity. So any update on that front? Are we taking any steps to increase our business in that region?
So, Rishabh, North America has historically been more than 50% of our total revenue. In H1 25, it was 55% of our turnover, and in H1 26, it is.
No, ma'am, I don't know South America, not the North.
South America. See, so if you look at our strategic intent, we've always said that our strategic intent is to about 40% of our business from North America, 30% from the US, about 25% from Asia, and 5% from rest of the world. So clearly, we've been focusing on growing our business in Asia and Europe, and to that extent, first half of 25, Europe was 23% of our turnover, and this time it is 25%. So you're seeing a clear growth in the European contribution in a growing top line that we have. And Japan was at 5% H1 25, and in H1 26 it's at 6%. So you can also see the Asian element growing, right? I think South America for us comes in rest of the world, which is a smaller bucket for us. So we are going to focus on the larger markets first.
Okay. My next question is, when we talk about 3PL and PMP, what has been our market share, let's say, now versus 4 to 5 years back? And how has it improved over the years? As we say, we have a dominant market share in this space.
Rishabh, I think we continue to enjoy a double-digit market share in the small ag market. What is it currently at the moment? We haven't done a market review in the last 3 months, so that I won't be able to tell you. But in the recent past, when we had done it, we were at a double-digit market share in the small ag, in the 3PL business. And in the CMP, we are in single high digits. That's the market share that we have. Now, I think the way we look at this is that in the large ag market in Europe, we continue to win new business, and we continue to solidify our position. Even in the small ag segment, be it North America, be it Europe, be it Asia, we are winning new business. So this, and this is despite the markets being weak, right? So our position, if at all, is staying where it is, if not improving. And similarly, in the construction industry, actually, we've just been growing tremendously, right? We've been growing with multiple customers, both in the US and in Europe. And there also, our position is only getting solidifying despite North America facing tariffs. Because bear in mind that what has made people really sit up during the tariffs in North America is saying, oh, here is Uniparts. Not only are they best cost country manufacturer, but they also have dual shoring. And now with our Mexico warehouse becoming operationally ready, we can give them so many tools in the kitty to be able to mitigate tariff impact. So I think our market share is only solidifying.
Okay, fine. Thank you.
Thank you. Ladies and gentlemen, in order to ask a question, you may press star and 1. The next question is from the line of Dheeraj Kumar from Alfa SQR. Please go ahead.
Ma'am, thanks for the opportunity. I have a couple of questions. The first question being, so if you see our historical earnings, right, I think the peak earnings was somewhere in 2023 where we did about 45 to 50 rupees, right? So when do you anticipate, right, based on the current visibility of all the different industries you are currently catering to, when do you anticipate we can get back to such a level?
So, if you look at how we have been indicating FY26, we've been saying FY26 should be in the mid-teens growth. And if the trajectory of the markets continues to be where it is, I think FY27 or mid-FY28 is where we definitely should be where we were with the peak revenues.
Got it. That's helpful, ma'am. And secondly, I just wanted to understand, because if you see in India, right, most of the precision engineering players have taken different routes, right? I mean, one being defense, aerospace, or some of the sectors where there are tailwinds, right? Be it mining or be it, energy, etc., right? Why are we actually restricting ourselves with industries which are extremely, I would say, they're not growing or they're probably degrowing because of multiple reasons, right? Do we have any plans, because we have the capability of doing precision parts? Why are we not thinking about a mining or say some other areas? It might be a naive question, but I just wanted to understand what is the hunger for the management, because beyond 1,500 crores, I mean, we are not able to understand how the company can really get to the next leg and unlock the shareholder value.
So there are multiple layers to your question. So let me peel the onion one by one, right? I think just to say 1,500 crores because that's the revenue we achieved in 2023 is a little bit of a misnomer. I think we can actually achieve that growth just with existing customers and existing partners in the time frame that I mentioned. We are constantly looking at inorganic growth and inorganic opportunities. We have the wherewithal to do it, and that will definitely add more value to shareholders. And the reason why we keep putting on so much of effort on this inorganic opportunity is because we just don't want to do an acquisition for the sake of acquisition. We actually want to do an acquisition which truly unlocks value for shareholders and is ROE and ROCE accretive, right? And hence it's taking us time. I think the third element is, today, do we supply to other off-highway segments other than agriculture and construction? Absolutely. We do supply to oil and gas. Some of our precision machine parts go into oil and gas. They also go into industrial machinery. It's just that we don't track them separately. I think what also is not appreciated is that when we say construction for us is not just infrastructure and building. It encompasses mining, metals. It also encompasses what we talk about, infrastructure for AI. So I must tell you that one of the new orders that we've won is actually for a customer that is going into their segment, which is then helping the development of the AI infrastructure. Now, for us, there is a huge amount of untapped potential within our customers to take care of some of the segments that you have spoken about, and that's where we are, putting our efforts. We are expanding into other segments where our capabilities can extend. And then the third one is the inorganic opportunity. So that's the way we look at growth.
No, got it. Thanks, ma'am. I just last question. So because you highlighted that this gross margin might not be sustainable, it might go to the normalized level. So you anticipate H2 would be again at that, we would see an EBITDA margin of 18-19% rather 21%, which we have seen in H1. Am I right? Or?
So, again, when you look at Q1, right? Or when you look at H1, again, the gross margin, you're right, is impacted by this material cost. But as you would also see that the deleveraging is playing out in our benefit, right? So once we normalize for the impacts that we've had, we are close to coming to the 20% levels of EBITDA that we have said we would always be trending towards.
No, I think that's helpful, ma'am. Thanks a lot. I'll come back in next.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Saurabh Das from GreenEdge Wealth. Please go ahead.
Yeah, hi. Thanks for the opportunity. I know that we have discussed at length on the margins, but just wanted to again check with you that you did mention that 18% is what you are essentially targeting in the near term with 20% as an aspiration, while the first half is extremely strong. So do we see that normalization likely to happen in the second half itself, or it will gradually trend towards the 18-19% levels?
So sort of what we are trying to explain is that the gross margin impact that we are seeing is due to the currency, the rupee depreciation. If the rupee depreciation continues, the gross margin will continue to benefit, right? When we normalize for the margin, for the rupee depreciation, right, we are looking at the range of 18 to 20% margin. I think what we are saying, it's not that we are targeting 18%. Our target has always been 20% because that's the normal EBITDA level at which we believe we operate in healthy markets and healthy cycle conditions, right? And I think over a cycle, that's what we will end up doing. It's just that at the moment, giving full clarity and saying, if you were to normalize everything, we would be in the range of about 19%.
Thank you. Thank you so much. And my next question is that when you gave the broader color on your end segments, the kind of growth, it kind of comes to either slightly negative to slightly positive between -2 to +5 sort of end market growth, while we are targeting mid-teen. So effectively, we are maintaining a spread of almost 7 to 10% over our end markets. So is that understanding broadly correct? So I can, look at it from a next 2-3 year perspective.
So Saurabh, I think couple of things to understand, right? And I'm going to reiterate this. The segment which is rightly said, which is red, is North America large ag, which is where we have a lower exposure to. Europe, which is small, large ag, is amber, which is where we've been winning new business in large ag. We have a good position in the small ag. Even North America small ag is in the amber. So there we are doing well. And construction is really green, and so is the Asia and India ag business, right? So we are really outperforming the market in the green and the amber segments, and we are flat when we talk about the red segment. I think what's key to note in our business is, and we've always said this, that the real growth comes from winning new business.
True, absolutely.
So if we talk about, let's say, a 15% growth, we are saying about 11 to 12% of this comes from new business, while the balance comes from the existing business. And that actually remains because our new order business win is very healthy at 200 crores.
Right. And just on that new business.
Sorry to interrupt, sir, but I may request you to rejoin the question queue for follow-up questions.
Yeah, sure. No problem. Thank you so much.
Thank you. Ladies and gentlemen, to answer questions from all participants, please restrict your questions to 2 per participant. The next question is from the line of Vipul Kumar from Sumangal Investments. Please go ahead.
Hi, thanks for the opportunity and congratulations for a very good set of numbers. So my question is, since construction is turning the corner, 2-3 years down the line, we can have a mix which is construction and that contributes around 60-65% of our overall revenue, or that is too optimistic? And secondly, if you don't give any exact figures, can you directionally say the margins for ag and PMP business are broadly similar, or they are different? Thank you.
So Vipul, I think to answer your second question, I think for us the margin business is dependent on our delivery channels. It's not dependent on 3PL or PMP. And I think we've always said that warehousing sale is the highest margin, direct exports is the base margin, and locally manufactured and locally delivered is the lowest margin. So I think that's the short answer to a question on what are the margins for 3PL and PMP. I think coming to will construction become a 60 to 65% business? Our efforts, if you see, right from the beginning have been to build a diversified business. So we have customer diversification, we have industry diversification, and we have geographic diversification. And I think this diversification is what we are going to continue to focus on, because this is very, very important to build a risk-mitigated business in the long term. So I don't think we would want to have over-reliance on any one industry, but that means that we will have to continue growing with all our customers, all their horizontal verticals across their geographies, so that the de-risking continues and the business continues to grow.
No, I didn't understand your comment about margin for both the segments. Would you repeat, please?
So the margins are not dependent on 3PL or PMP.
They are both the same.
Because they tend to be the same. The margins actually are by the delivery channel of the business.
Means warehouse is the highest margin, if I have understood you correctly.
Warehouse is the highest margin, direct export is the base margin, and locally made, locally produced is the least margin.
Okay, thank you very much.
Thank you. The next question is from the line of Shiladitya, an individual investor. Please go ahead.
I hope I'm audible here.
Yes.
Yeah. So I think you have
given some high-level guidance for mid-teens growth for FY 26. So, can you give some color on the different segments, how each of these will perform? And also going forward, like FY 27, FY 28, next couple of years maybe, how the expectation is?
Right. I think, Shiladitya, if I was just to go back and look at the segments, right? The construction segment globally has started to come up with the trust. So this is a segment that is really growing. It's doing well, and this is both in the US and Europe. In the US, it's driven by, of course, government spends on infrastructure, but more importantly, the emphasis that is on building AI infrastructure. In Europe, the emphasis here is on green energy, and so the sector is growing. And here, we actually are outperforming the market, driven by new business wins. Given that the trough of the cycle is past us, the segment is going to look up in FY 27 from where we are today. Then when we come to small ag, in the small ag business, we believe that in North America, the worst may be behind us, but there is a plateau that is happening before the recovery begins. So clearly, FY 26 is looking better, but the growth will really come in FY 27 in this segment in North America. In Europe, small ag is looking better, and so I think as the growth continues, FY 27 will look better. In Asia, the market is already looking good for ag, and this is all small ag largely. And same as India, and we expect this to continue. And in India, the GST rate cuts are an impetus to the industry, right? Again, in the small ag market, in all our geographies, we are outperforming the market. And then comes the large ag market. Large ag market doesn't exist in Asia. It's predominantly North America and Europe. The European large ag market is definitely recovering. More than 40% of the manufacturers of equipment actually expect their next 6 months turnover to be better than their last 6 months turnover. And I think we are winning new business here. So we are again looking to outperform the segment. And when you look at the North American market of the large ag, there we still need to see the bottoming out. And there, I think FY 26 will see double-digit degrowth, but hopefully the bottoming out will happen, and then we will start seeing growth in FY 27. In this segment, our performance is flat.
So all in all, can we assume, or can we at least right now thinking like FY 27 should be a better year in terms of growth compared to FY 26, based on the outlook what you shared? Can we
based on the data that we are seeing today, based on the order books that we are seeing today, based on the customer interactions that we have today, yes, FY 27 looks better than today.
All right. And second question is on this, in your business, like is there an element of operating leverage, like for example, once the growth kicks in?
Sorry, Shiladitya, I couldn't understand you.
No, what I was asking is, in our business, as the growth kicks in, what kind of operating leverage do you have in the business? Like, is there a margin expansion normally happens along with the growth? And because historically I see that when your revenue was high, your margins also went up. So I'm just trying to understand the operating leverage part in the business.
So that's absolutely true, Shiladitya, that there is operating deleverage, and I think the quarter one results and the H1 results are testaments to that, right? I think if you see the quarter one results, you will see how the operating deleverage can play out. Quarter two, you have a little bit more of the FX impacting the material costs, but if we were to normalize everything, clearly our EBITDA margins are improving from what they were a year ago, and that's the visibility of the deleveraging impact.
All right. Thanks, ma'am. Thank you.
Thank you. Ladies and gentlemen, in order to answer all questions from all participants, please restrict your questions to one per participant. The next question is from the line of Viraj from Simple. Please go ahead.
Yeah, just two questions. First is, if you look at the run rate we are doing in the first half, and if I have to analyze it, we will be doing similar run rate as what we did in FY24, which is around 1,140 crores. But if you look at the top largest customer for you, it used to be 32% of your revenue, which is now 27%. So while you talk about new wins and increase wallet share, for the largest customer, is there any share loss or what is causing this degrowth? So that is one. And second question is on the gross margin improvement. So you said that remaining 15 to 20% of the improvement is due to product mix and tariff. But tariff, how does it help you in improving margins? So if you can just give some color.
Right. So I think, Viraj, we haven't lost any market share with the largest customers. It's just that, what has gone away from the largest customer has gone into the pool of the second and the third customer. So if you were actually going to look at the presentation where you talk about, the customers that we have and the split that we have by customers, right? You will see that it's the share of business that we have with the share of business that we have with other customers has grown, right? So top 5 customers, today have 17. Top 10 customers have 79%, where they were 76%. Top 5 customers are 64%, where they had 59%. So it's not that we are losing share with that customer, it's just that it's getting distributed to other customers because we are growing faster with the other customers.
No, I understood that. What I was trying to understand, if I look at an absolute sales from the largest customer, it did something like 360 odd CR, and if I have to analyze this based on the new percentage shares at 27%, we will be somewhere around 300 crores. So I'm just trying to understand, if it's share loss or, is it new programs not being awarded, or I'm just trying to understand what is causing the absolute sales drop from the largest customer.
So, you also have to keep in mind that different customers that we have had different degrowths from 24 to 26 themselves. So you can't look at our sales to them as a single data point. This has to be looked at in congruence with what is their production today, right? Only then will we be able to say whether we've lost market share or not. And to that extent, I'm telling you, we've not lost any market share.
Okay, and the tariff?
Sorry to interrupt, sir, but I may request you to rejoin the question queue for follow-up questions. Thank you. The next question is on the line of Dheeraj from Alfa SQR.
Ma'am, thanks again for the opportunity. Just for the inorganic side, right? I mean, what is the process we are having today? I just wanted you to go a bit deeper and help us understand, like, what is the thought process? What are we intending to do? What are the typical valuations which you are looking at, revenues, etc., which areas of acquisition? Maybe if you can, help us understand.
So, Dheeraj, this is something that we have maintained since our IPO. We are looking at global acquisitions because we believe in being a best cost country provider to our customers. We are global suppliers and our customers are global in nature. We want to supply to all their facilities. So to start with, we are looking at global acquisitions, but these acquisitions have to be strategic in nature, which means for us, they have to be able to help us extend and shift our system boundaries. So from our current product platform of 3PL, PMP and small fabrications, they need to be able to help us get into large fabrications, hydraulics and PTOs. Now in these areas, wherever we have technology, wherever we have product extensions that can help us bring more value to the customers, where we will look at acquisitions. We are not limited by, given that we are debt-free and that we have cash on the balance sheet, we are not really typically limited by saying a small acquisition. I think we are looking at making acquisitions that are meaningful, and we are not going to look at acquisitions that are deep turnaround stories. That's not something that we want to do. We want to do something that is ROE accretive and ROCE accretive and strategic to the customer. So I think those are the broad contours that we are looking at.
Understood. Ma'am, does it mean that you want to acquire some...
But I may request you to rejoin the question queue for follow-up questions.
Sure, thanks.
Thank you. The next question is from the line of Prolin from Edelweiss. Please go ahead.
Hi, thanks again for giving me the opportunity. Two questions, and both are in a way related, right? One is that you mentioned that, tariff has made a lot of your customer realize Uniparts quality, right? How should that translate to higher new order wins, right, in a way? Because,
Sorry,
maybe...
I can't understand you. So the first part of your question was not clear to me at all.
Sure. Are you able to hear me better now?
Yes.
Okay. Apologies, I'll repeat. What I was saying was that the customers have been, coming back to you with, more RFQs, as well as this tariff thing has made them realize that Uniparts has some unique capabilities, right, which the peers does not have. How should this translate to higher, new business wins going forward? Because FY26, we are still at that 15-16% number, 11-12% coming from new businesses, and 3-4% coming from the existing business. Should it ideally lead to a higher growth going forward because of whatever tariff realization customers have had? And also, one more point is that, do you internally track, something like an innovation index where, what would be the percentage of products which would have been launched in the last 3 years? What would be the share in the overall revenue? Just to help us understand, is there an additional lever to market share gains beyond, dual shoring and the cost aspects as well?
So I think, if you look at our new business that we keep tracking, that actually is a very good indicator of saying how are we being looked at by customers, what are the new businesses that we are getting, which can be new products with new customers, it could be new products with existing customers, it could be existing products with new customers, right? And that, a year ago, if I was to look at it, was about 175 crores. And today that number sits at 200 crores. So that should be able to give you how the new business is growing, right? And this is despite the tariffs coming in. I think the strength that the customers are beginning to realize and why we are getting this new business award is because obviously we have US manufacturing that can help them, and now we have a Mexico warehouse that can enable delivery to Mexico where they can actually assemble and sell into the US, right? But that is just the US geography. Also remember, we are growing in Europe. Europe was only 23% of our share of revenue in H125. This time it's 25%. So a lot of our efforts are also going into winning new business in large ag in Europe and in construction, right? Similarly, we are also putting in a lot of effort to diversify where we can. Now, Asia small ag is a smaller geography and a smaller market from that perspective because we have a dominant position in the small ag market. But again, Japan was 5% of our revenue in H125 and this time it's 6%. So I think that's how I would look at growth opportunities and how customers are seeing them.
Thank you so much. That's it from my side.
Thank you. The next question is from the line of Vipul Kumar from Sumangal Investments. Please go ahead.
Hi. So, what is our R&D spend, madam?
Sorry, what is our R&D spend?
Yeah, research and development. What is the amount we are spending per annum on R&D?
Before I think what we do is we have a significant amount of investment that goes into design, into process engineering, and co-development of parts with our customers. I think I don't have the number at the top of my head. I can come back to you on that.
Could I take you offline with you, ma'am?
Yeah, you can get in touch with our team and they will give you this number.
And lastly, ma'am, would you repeat sales by channel mix? I mean, warehouse, exports from India and...
Warehouse is roughly 50%, direct exports is roughly 25%, and local made and local sold is about 25%.
Thank you, ma'am.
Thank you. The next question is from the line of Miten Latia from Fractal Capital Investments. Please go ahead. Sorry to interrupt, sir, but your voice is not clear.
Is it clear now?
Yes, sir.
Yeah. Hi. Should we take this quarter as being representative of the full impact of tariffs on our business? Why I ask this is because we have inventory in the warehouse which we would have sold through in this quarter, and hence, the full impact may not be visible. Just wanted to get that clarified.
So then we can't take this quarter as a full representation of tariffs because tariffs is an ever-evolving situation. For example, in my call, I mentioned that, earlier on that on the 31st of October, there's a new ruling that has come in which announces a flat 25% duty on some of the tractor parts, right? This is away from the 50%. So this is a situation that will keep evolving. We also have inventory that keeps moving through, right? Because it's not that we just keep storing, we also keep selling. But given that tariff is an ever-evolving situation, I don't think this is a quarter which is representative of tariff.
I understand that the situation is ever-evolving, so we can never be sure of it. But let's say, given what we know about current tariffs, as in some at 25 and some at 50, if at all something is at 50, I don't know if anything is at 50 for us. But to that extent, would we have any residual impact left in which will flow through in the subsequent quarters? If you could provide some heads up on that.
So the thing so when the tariff situation began, we had two tariffs levied on us, right? One was Section 232, which is on the steel and derivatives component. Now that initially started with 25% duty, then it went to 50% duty. Then the change came in saying that on your steel and aluminum content you will pay 50% duty, but on the balance you will pay reciprocal duty. Then when the Russian oil came in, it said now you will also pay Russian oil. So that's one aspect. The second aspect when we started was with reciprocal duty, which started with 10%. Then it got increased to 25%, and then we have the Russian oil tariff getting implemented now, right? From this month onwards, 25%. And then you have the 31st of October ruling, which is coming for new parts. So there is so much of variability in this that it's very difficult to say that quarter two is representative because there are constant moving parts to this. From a P&L perspective, at every stage of tariff change, we have sat down with customers in open, transparent discussions and have been able to reach agreements such that our P&L is neutral. So to that extent, we don't believe there is any impact on the P&L because of the tariff. What I also mentioned is that this new ruling that has come in on tractor parts actually is helping us on the aftermarket side because the tariff is reduced and that's helping the aftermarket customers pick up a little more. So from that perspective, if at all, it's only a positive to the P&L.
That is very helpful. Thanks. Appreciate that.
Thank you. Ladies and gentlemen, we will take that as our last question for today. I would now like to hand the conference over to the management for closing comments.
Thanks a lot. Thank you for all these questions, investors. So, I just want to conclude by saying that we continue to focus on our core strengths and build stronger business franchise by strategically partnering with our customers in their journey and success. Our focus and efforts are aligned towards achieving the targeted growth in coming years. And so with this, I would like to thank all of you for taking out your time to join today's call. Thank you so much.
Thank you. On behalf of Go India Advisors LLP, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.